All right, get ready to dive deep because today we're tackling EPF exempted trusts in India.
Yeah, we're going to unpack it all.
Eligibility, investment strategies, those auditors, everything.
Going to be a deep dive for a reason.
By the end, you'll be able to talk about this stuff like a pro.
Oh, yeah.
So like, for anyone who's maybe not super familiar with this whole thing,
Right.
let's back up a sec. What exactly is the Employee Provident Fund?
You got it. Think of it like a safety net for retirement.
Okay.
Employees and employers put in a little bit of money each month,
Yeah.
building up that nest egg for the future.
Gotcha.
Most companies just hand that money over to the EPFO, the government,
Right.
But some organizations, if they meet certain criteria, they can apply for an exemption,
Okay.
which means they get to manage those funds themselves.
So it's kind of like managing your own investments instead of using a mutual fund or something.
That's a great way to put it. More control, but way more responsibility too.
Exactly. And that's what we're going to dig into today, right?
Right. We're going to look at a real auditor's report for these exempted trusts.
Oh, fun.
It's packed with rules and regulations. Think of it like a roadmap
Okay.
to make sure everything's on the up and up.
And that the trust is doing its job right, protecting those retirement savings.
Exactly.
And let me tell you, this roadmap is pretty intense.
Yeah.
It's not just like stashing cash in a savings account.
No.
There are all these rules about like how fast they have to invest the money, what they can even invest in. It's a lot.
Absolutely. I mean, we are talking about people's futures here.
Right.
So the government is not messing around. These regulations are serious business.
They want to make sure that money is managed super carefully.
For sure.
Okay, so let's start at the beginning.
Okay.
Who can even get this exemption?
Right. It's not easy. Think of it like an exclusive club. Super high standard.
Gotcha.
Not just any company can say, hey, we want to manage our employees' EPF.
Right.
There are a lot of criteria. The auditor's report lays it all out, like every single unit in the organization.
Okay.
That's going to be part of the trust. They all have to be notified for exemption.
So if you're like a big company with tons of branches,
Yeah.
every single one needs to be on board.
You got it. Consistency is key.
Yeah.
And everyone, all eligible employees, got to be covered by the same rules.
And that includes contract workers too, right?
Everybody. No picking and
I
choosing.
get the paperwork for all this is insane.
Oh, you have no idea. Mountains of it.
What kind of stuff do they have to provide to even be considered?
Well, the report's very specific. Got to provide a list of every single participating unit.
Wow.
Locations, contact info, the number of employees, everything.
So they can see the whole picture, huh?
Yep. Then you've got all the exemption notifications.
Dates, all that.
Yep. Numbers, validity periods, the whole 9 yards.
Wow.
And of course, bank account details.
Oh, right.
The auditor needs to know where the money's going, who has access.
It's all about accountability. All right.
We're talking about people's livelihoods here. Got to be meticulous.
Makes sense. So, okay, say a company goes through all that, gets the exemption.
Yeah.
Who actually runs the show? Who manages the trust?
That's where the board of trustees comes in.
Go
They're the ones making the big decisions about the money,
Gotcha.
investments, claims, everything.
So it's not just like a bunch of executives in a room deciding what to do with the money, right?
Nope. The board's makeup is super important. The auditor checks that very carefully.
I bet.
Has to be balanced with representatives from both the employer and the employees.
Oh,
So everyone's interests are represented.
checks and balances. I like it.
Exactly. And get this, any changes to the EPF scheme that benefit employees,
Yeah.
the trust has to incorporate those into their own rules.
So like if the government says, hey, everyone gets a higher interest rate,
Exactly.
the trust can't just ignore that.
Nope. Got to keep up with the times. Put those employees first.
Very cool. So we've talked about who's eligible, who's managing. Let's get to the nitty gritty.
Okay.
The contributions themselves.
Uh-huh.
How does the auditor make sure everyone is paying what they're supposed to?
That's where things get really intense. The auditor's report is super clear.
Okay.
Every single eligible employee has to be enrolled.
Right.
Their contributions have to be deducted, deposited, everything by the book.
Gotcha.
And the auditor is checking for any discrepancies, missed payments.
Really scrutinizing every little
Like a
thing.
financial detective, yeah.
Making sure there are no mistakes, no funny business.
Exactly.
And what about contract workers? Are they included in all this?
Absolutely. They check that very carefully, making sure contributions are handled correctly.
Okay.
They track every single rupee, calculate interest under Section 7Q of the EPF Act.
Hold on. What's Section 7Q interest?
Good question. It's the interest that gets added to employees' EPF accounts each month.
Oh,
calculated on their balance. It's how those savings really grow over time.
Gotcha. So the auditor makes sure that's all done right.
You bet. And then there's Section 14B. That's all about keeping things fair.
Okay.
If an employer messes up, delays contributions, they get hit with penalties.
Wow.
The auditor checks that those penalties are being applied correctly.
So it's all about protecting the fund, making sure everyone's doing what they should.
You got it.
Okay, so we've got the contributions all sorted.
Right.
But what happens when someone needs to actually use that money?
Good point. It's not just about putting money in, it's
Yeah.
about getting it out when you need it.
Exactly. So how do claims work? What's the auditor looking for there?
The report spends a lot of time on claim settlements. They want to make sure it's all fair and above board.
Makes sense.
They look at how long it takes to process claims, why there might be delays or rejections, making sure everything's done according to the rules.
So nobody's getting the runaround when they need their money.
Exactly, protecting those employees.
And it's not just about retirement, right?
No.
People might need to take loans against their EPF balance sometimes.
Absolutely, for things like medical bills, education, even buying a house.
Right.
The auditor checks that those loan applications are evaluated properly,
Okay.
making sure the amounts are within the limits, interest rates are fair.
So that's like a safety net even before retirement.
Exactly, but it has to be managed carefully.
Right. So speaking of managing carefully, what about the interest rates?
Ah, yes, the money doesn't just sit there, it needs to grow.
Right. And I'm guessing there are rules about that too.
You bet. The trust has to offer an interest rate at least as good as what the government sets.
Okay.
It's like a minimum they have to meet.
Makes sense. But what if their investments don't do well enough to match that rate?
That's where things get tricky. The auditor's report is very clear.
Okay.
The trust has to be transparent if they need extra money to cover those interest payments.
So they can't just make up the difference out of thin air.
Nope. They have to explain where the extra money's coming from.
And the auditor checks that, right?
Absolutely, making sure it's all legitimate.
Yeah. So it's all about maintaining trust, being accountable.
Exactly, for the employees and for the regulators.
Okay, so we've covered eligibility, contributions, claims, interest rates,
It's a lot, right?
but there's still one big piece of the puzzle.
Mm-hmm.
How do these trusts actually invest the EPF money?
That's the million-dollar question.
And what safeguards are there to make sure those investments are both profitable and safe?
That's what we're going to tackle next.
I can't wait. It's where things get really interesting.
It is. It's where the strategy comes in.
Okay, so we've learned that managing an EPF exempted trust, it's not a walk in the park.
Not even close.
There's all these regulations, responsibilities, and those auditors always watching.
Always watching, yeah.
But now let's get to the fun part, the investments.
This is where it gets real, right?
Well, we talked about the money coming in, the claims going out,
Right.
making sure those interest rates stay healthy.
Mm-hmm.
But all that depends on how well they invest those funds.
Exactly. This is where the rubber meets the road, like you said.
So it's like taking all those contributions, pooling them together,
Yeah.
and turning it into a big engine for growth.
It is. But like any engine, you got to take care of it.
Right. Make sure it doesn't blow up.
Exactly. And that's where the auditor's report comes in. It's like our manual.
Okay.
It lays out a very specific investment pattern the trust has to follow.
So they can't just invest in whatever they want.
Oh, no. There are rules.
Okay.
They have to allocate certain percentages to different types of investments.
Like what?
Government securities, debt instruments, equities, a mix.
Diversification, spreading the risk.
Exactly. Smart investing.
So within each of those categories, are there even more rules?
Oh, yeah. Tons of them. For example, they can't invest in debt securities that mature in less than 3 years.
That's interesting. Why is that?
Well, think about it. They're managing retirement funds, right?
Yeah.
So they need long-term stability, predictability.
Makes sense.
Shorter-term investments, they can be more volatile, riskier.
And they don't want to gamble with people's retirement money.
Exactly. So the auditor, they're checking all this very carefully,
I bet.
making sure the trust sticks to the pattern, any deviations,
Yeah.
boom, surcharge, a penalty that hits their returns.
So there's a real incentive to get it right.
Absolutely. And we can't forget about arm's length transactions.
That's that.
It means, if the trust invests in a company that's related to the employer,
Okay.
they have to make sure it's a fair deal, no funny business.
So they're not just favoring their own companies.
Exactly. No conflicts of interest. The auditor is all over that.
So they're looking out for the employees.
Always. Making sure those investments are in their best interest.
Okay, so even with the best investments, there's always a chance of losing money, right?
That's true. Markets can be unpredictable.
So what happens if an investment goes bad? Who takes the hit?
The auditor's report is very clear on this one. The employer is responsible.
Oh, wow. So they're really on the hook.
They are. They chose to manage these funds, so they take on the risk.
It's a big responsibility.
It is. If investments lose money, they have to make up the difference.
Wow.
Got to keep that fund stable, protect those employees.
So transparency is really important here.
Absolutely. The employer has to provide a certificate from a third-party auditor
Okay.
showing that the trust's finances are healthy, no hidden problems.
So it's like a seal of approval.
Exactly. Giving everyone peace of mind.
Now, we've talked a lot about the rules and the risks,
Yeah, it can seem a bit daunting.
but there must be some advantages to these exempted trusts, right?
Oh, absolutely. There are some real potential benefits.
Okay, I'm all ears. Let's hear it.
First off, higher returns, remember, they have to match the government's interest rate.
Right.
But with smart investing, they can actually do better than that.
Oh, interesting.
So employees could end up with more money for retirement,
That's a good incentive.
right? And then there's flexibility.
Okay.
They can tailor their investment strategies more than the EPFO can.
So they can be more specific, target certain opportunities.
Exactly. But that means they need a good investment team, people who know what they're doing.
Right. Experts.
Yep. And then there's faster claim processing.
Oh, that's a big one.
Right. They often have more streamlined processes so employees can get their money quicker.
When they need it, that's important.
Absolutely. And finally, even though there's a lot of oversight,
Yeah.
it actually leads to more transparency for employees.
How so?
Well, they have access to more information. They can see how their money's being managed.
Oh, I see. So they're not just in the dark.
Exactly. They feel more involved, more in control.
So it's not all doom and gloom then.
Not at all. There are some real upsides.
But like with anything, there are also downsides, right?
Oh, yeah. Got to be realistic.
What are some of the biggest risks companies need to think about?
Well, the biggest one is always investment risk.
Right. The market can be unpredictable.
Exactly. Even if you're careful, you can still lose money.
And the employer has to cover those losses? That's a big deal.
It is. It can hurt their bottom line.
And if things get really bad, they could lose their exemption altogether.
Yep. Back to the EPFO. And that's not always a smooth transition.
So the stakes are high.
Very high. And then there's the risk of mismanagement if the trust isn't run properly.
Right. If the board doesn't know what they're doing,
Exactly. That's where the auditor comes in. They're watching for any red flag.
keeping everyone honest.
Yep. And don't forget, managing an exempted trust, it's a lot of work.
Oh, yeah, I bet.
You need dedicated staff, expertise, systems. It's a big administrative burden.
And that costs money.
Exactly.
Yeah.
So companies have to weigh the costs and benefits very carefully.
It's a complex decision.
It is. There's no easy answer. What works for one company might not work for another.
Okay, so we've covered the basics, the investments, the
It's
risk.
gone deep.
But now I want to talk about a specific group of employees.
Oh, hey?
International workers.
Ah, yes. That adds another wrinkle to the whole thing.
It does. They bring their talents to India. But they often have different retirement plans, different rules from their home countries.
It's like trying to fit two different puzzle pieces together.
Exactly. So how does that all work with the EPF?
Well, the auditor's report has a whole section on this. It's very helpful.
Okay.
It outlines how to make sure the EPF is managed correctly for international workers.
I'm intrigued. Let's dive into that. All right. So we've spent a good chunk of time really digging into the nuts and bolts of these EPF exempted trusts in India.
We have, yeah.
From who can even have one to how they invest the money, those audits, everything.
Mhm.
But now let's zoom in on a specific group,
Oh, wait.
international workers.
Ah, yeah. They bring a whole other set of challenges to the table.
It's like adding another dimension to this already complicated system.
Right, like trying to solve a puzzle, but the pieces keep changing.
Exactly. So how do these international workers fit into the whole EPF picture?
Well, luckily, our trustee auditor's report has a whole section on this.
Okay.
It gives us a roadmap for making sure things are handled correctly.
So where do they even start? What are they looking for when it comes to these workers?
First things first, they want to know who these folks are, right?
Okay.
The report needs all the details, their UAN, nationality, when they join the company,
Oh, wow. Everything.
even their salary. Gotta have the full picture.
So they can make sure they're properly included in the EPF system.
Exactly. No one's slipping through the cracks.
And then I'm guessing the big question is the employer doing their part?
You got it. Are they filing the right paperwork?
On time, accurately, all that.
All of it. Remember, timely reporting is super important.
Right. We learned that the hard way earlier.
Yeah. Any mistakes can cause delays, penalties, a whole mess.
And I imagine with international workers, it's even more complicated.
Oh, yeah. There's a higher chance of something going wrong.
Different rules, different systems. It's a lot to juggle.
Absolutely. So the auditor is extra careful in these cases.
Now, you mentioned before that some international workers might already have retirement plans from their home countries.
Right. They might be contributing to something back home.
So how does that work with the EPF? Do they have to contribute to both?
That's a great question, and that's why the auditor checks to see if the trust has updated their rules to accommodate these international workers.
So they're not double dipping, or worse, getting penalized.
Exactly. They have to make sure everything's aligned with international regulations.
It's like a balancing act, making sure everyone's treated fairly.
It is. It takes some serious expertise to get it right.
Now, I keep seeing this term, certificate of coverage, in the report.
Ah, yes, the COC.
What is that exactly?
It's basically a document that says which country's retirement system the worker will be contributing to.
So it prevents double contributions, clarifies things.
Exactly. Are they covered by the Indian EPF or their home country system?
The COC makes it clear.
And the auditor checks that the trust is handling those COCs correctly.
No expired cases, no one falling through the crack.
Yep, got to dot all the I's and cross all the T's.
Makes sense. So at the end of the day, all this is about making sure employees have a good retirement.
That's the goal, yeah.
So how does the auditor check that the claims process is working for these international workers?
Well, they look at how the trust settles those claims. Are they doing it fairly?
Okay.
Are they following the rules? Are there any unjustified delays or denials?
Making sure they're not giving anyone a hard time.
Exactly. Those workers deserve to access their funds without any hassle.
Absolutely. It's their money. They earned it.
It is, and that's what the EPF is all about, financial security for everyone.
Well, I think we've covered a lot of ground today.
We have.
We've explored the ins and outs of these EPF exempted trusts.
All the twists and turns.
From eligibility and investments to those crucial audits, and now even international workers.
It's been a journey.
I feel like I could pass an exam on this now.
I think you could. You've asked all the right questions.
Well, I had a great teacher.
Oh, shucks.
But seriously, thank you for breaking it all down for us.
My pleasure. I hope our listeners found it helpful too.
I'm sure they did. It's important information for anyone working in India.
It is. It affects their future, their retirement, their peace of mind.
And I think we did a good job of explaining it in a way that everyone can understand.
I hope so. It's not always the easiest topic.
No, but it's definitely an important one.
So to wrap things up, I just want to say, this world of EPF exempted trusts, it's always changing, new rules, new challenges. It's a lot to keep up with.
It is.
But the key is to stay informed, ask questions, don't be afraid to speak up.
Good advice. And for our listeners, thank you for joining us on this deep dive.
Thanks for listening, everyone.
We'll see you next time. Keep learning, keep exploring, and keep that retirement fund growing.
This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Welcome to this discussion on the Employees Provident Fund Organization Audit Report. We're diving deep into the complexities of EPF regulations.
Indeed. This report reveals a fascinating interplay between trust management, employee rights, and investment strategies.
It's a dense document, isn't it? Full of conditions, annexures, and seemingly endless details.
Absolutely. But understanding these details is crucial for ensuring compliance and protecting employee benefits.
So let's start with the core purpose, re-auditing the accounts of exempted trusts under the EPF scheme of 1952.
Precisely. Condition 24A of Appendix A, Para 27AA, sets the stage for this rigorous examination.
The report's structure is quite methodical. It begins with a statement confirming the audit's conduct and the inclusion of key financial documents.
Yes, the audited income and expenditure account, balance sheet, and Form RM-6 are all essential components. Form RM-6 is particularly important as it details the particulars of the exempted establishment.
Right, and the auditor's opinion, based on their examination of the books and provided explanations, is a critical element. Any observations or qualifications are clearly stated.
Correct. This section establishes the foundation for the detailed analysis that follows. The auditor's signature and seal, of course, add the necessary legal weight.
Part I delves into the details of the audit firm itself, including the names and credentials of the team members.
This transparency is vital for establishing the credibility and expertise of the auditors. Their FRN, the membership numbers of the chartered and associate chartered accountants, and their experience are all key pieces of information.
Okay, moving on to part 2, we find details about the establishment being audited. Name, address, PF code, PAN, and ownership type are all meticulously documented.
This section ensures that the audited entity is clearly identified and its legal structure is understood. The inclusion of details on participating units and branches is also crucial for a comprehensive audit.
The report also verifies the exemption under the EPF and MP Act 1952 and any relaxations granted. This is a critical aspect of compliance, right?
Absolutely. The legal standing of the establishment is paramount, and any changes in legal status must be reported promptly. The details of bank accounts are also included for financial transparency.
Part 2 also focuses on the exempted EPF trust itself, including its PAN, name, and the details of its income tax recognition order.
The composition of the Board of Trustees is a key area of scrutiny, ensuring compliance with Para 79C of the EPF scheme. The report verifies the representation from both employee and employer sides.
Right. The report meticulously checks whether beneficial amendments to the EPF scheme have been incorporated into the trust's rules.
This is crucial for ensuring that employees receive the maximum benefits allowed under the law. Any amendments made by the employer outside of those necessitated by changes in the EPF scheme are also examined.
Part 3 shifts the focus to employee enrollment. It verifies that all eligible employees, including contractual employees, are enrolled as members.
The report also checks whether the employer has paid the due PF contributions to the trust. It addresses the handling of excluded employees and the remittance of contributions to the EPFO where applicable.
Part 4V examines remittances and returns. The contribution rate, monthly contributions, and the calculation of interest and damages are all verified.
The report meticulously investigates any missing contributions, wrong postings, or other discrepancies. The timely filing of monthly and annual returns is also a key aspect of this section.
Okay, Part V focuses on claim settlements. It verifies that all claims are settled within the prescribed time frame and that loans and advances are sanctioned according to eligibility criteria.
The report also analyzes rejected or returned claims, providing reasons for rejection and calculating the percentage of rejected claims. The transfer of accumulations from previous employers is also verified.
Part 6 deals with interest rates, ensuring that the interest declared by the Board of Trustees is at par with or higher than that declared by the central government.
The report also verifies that interest is credited to member accounts on a monthly running balance. Part 7 delves into the investments made by the trust.
It checks whether investments are made within the stipulated time frame and according to the notified investment pattern. The report meticulously examines the composition of the investment portfolio.
The report verifies compliance with various investment regulations, including limits on specific asset classes and the required credit ratings for bonds and commercial papers. It also checks for compliance with arm's-length transactions.
Part 8 examines losses and expenditures, verifying that prior approval was obtained before the sale of any security and that all commissions and incentives were credited to the trust's account.
The report also checks for TDS deductions on interest and maturity payments. Part 9 focuses on international workers, verifying compliance with Para 83 of the EPF scheme.
Right. The report examines the filing of returns related to international workers and the appropriate amendments made to the PF rules. It also details the handling of COC, Certificate of Compliance cases.
The report ensures that balances withdrawn from the PF accounts of international workers are in accordance with the scheme's regulations.
Part X addresses other matters, such as unclaimed amounts and amounts liable to be transferred to the Senior Citizen Welfare Fund.
Part 11 deals with additional points to be incorporated in the audit report in case of cancellation or surrender of exemption. This section is crucial for ensuring a smooth transition if the exemption is revoked.
The report meticulously checks for compliance with various regulations related to the transfer of assets and liabilities to the EPFO in case of exemption cancellation.
It verifies that all dues, including contributions, interest, damages, and inspection charges, are paid before the exemption is surrendered. The financial health of the trust is also assessed to ensure no liability falls on the EPFO.
The annexures provide detailed supporting documentation for the various aspects of the audit. This comprehensive approach ensures a thorough and transparent evaluation of the trust's financial management and compliance with EPF regulations.
Yeah, the level of detail in this report is remarkable. It leaves no stone unturned in its pursuit of ensuring compliance and protecting the interests of employees.
Annexure A details participating units and their branches, ensuring complete coverage of the entities under the trust's purview.
Annexure B provides a comprehensive overview of exemption notifications and relaxation orders for each participating unit.
Annexure C and E meticulously list the bank accounts maintained by the establishment and the trust, respectively.
Annexure D provides a detailed analysis of the composition of the Board of Trustees, ensuring compliance with the prescribed regulations.
Annexure F provides a detailed breakdown of employee numbers, categorizing them by employment type and eligibility for PF contributions.
Annexure G meticulously details the salary and wage components, clarifying which portions are subject to PF contributions and which are not.
Annexure H provides a comprehensive list of contractors and their employees, indicating whether they are covered under EPFO or the exempted trust.
Annexure I meticulously tracks the payments made to contractors and the subsequent deposits with EPFO, ensuring transparency and accountability.
Annexure J details the monthly PF contributions, including calculations of interest and damages for any delays in payment.
Annexures K and L provide similar details for inspection charges and outstanding dues, respectively. Annexure M tracks the timely filing of returns.
Annexure N details claim settlements, including reasons for any delays.
Annexure O provides details of loans and advances, highlighting any deviations from eligibility criteria.
Annexure P meticulously reconciles the interest rate declared by the trust with the income earned and the interest credited to members' accounts.
Annexure Q tracks the receipt and investment of funds, noting any delays and the associated surcharges.
Annexure R provides a detailed reconciliation of the trust's funds, calculating the fresh accretion during the year.
Annexure S details the investment portfolio, comparing the actual investments with the prescribed investment pattern and calculating any surcharges for deviations.
Annexure T provides a detailed list of securities held by the trust, including their ISIN, maturity dates, and coupon payment dates.
Annexure U tracks the receipt of maturity proceeds and interest payments, noting any delays in the associated overdue amounts.
Annexure V details TDS deductions on interest and maturity payments.
Annexure W provides a detailed list of international workers, ensuring compliance with the specific regulations applicable to them.
Annexures X and Y detail unclaimed amounts and amounts liable to be transferred to the Senior Citizen Welfare Fund.
Annexures A1 and B1 provide details of the transfer of cash and securities in case of exemption cancellation.
Finally, Annexure C1 provides the audit certificate confirming the financial health of the trust. This audit report is a testament to the meticulous nature of EPF regulations and the importance of ensuring compliance.
The level of detail is truly impressive, leaving no room for ambiguity or misinterpretation.
Understanding this report is crucial for anyone involved in managing exempted EPF trusts. Let's revisit the significance of Form RM-6. Why is this form so crucial in the context of this audit?
Form RM-6 serves as a central repository of information about the exempted establishment. Its accurate completion and verification are essential for demonstrating compliance with EPF regulations. Any discrepancies or inaccuracies in this form can lead to significant issues.
The report emphasizes the timely filing of returns. What are the potential consequences of failing to file returns on time?
Late filing of returns can result in penalties, interest charges, and even legal action. It can also damage the reputation of the establishment and erode trust with employees. Timely filing is crucial for maintaining compliance and avoiding potential repercussions.
The report highlights the importance of maintaining proper records. What are some best practices for record keeping in this context?
Maintaining accurate and up-to-date records is paramount. This includes meticulous documentation of all financial transactions, employee details, contributions, and claim settlements. A robust record-keeping system ensures transparency and facilitates smooth audits. Regular internal audits can also help identify and rectify any discrepancies early on.
The report frequently mentions compliance with various conditions and regulations. What is the overall significance of adhering to these conditions?
Adherence to these conditions is not merely a matter of compliance. It's a matter of ensuring the financial security and well-being of employees. These regulations are designed to protect employee benefits and maintain the integrity of the EPF system. Non-compliance can lead to significant financial and legal repercussions.
The report emphasizes the importance of investing funds according to the notifying investment pattern. What is the rationale behind this strict adherence to investment guidelines?
The investment guidelines are designed to ensure the safety and growth of employee funds. By diversifying investments and adhering to specific risk parameters, the EPFO aims to maximize returns while minimizing potential losses. This approach protects the long-term interests of employees and ensures the sustainability of the EPF system.
The report mentions several instances where the employer is responsible for compensating losses. What is the rationale behind holding the employer accountable for such losses?
The employer is ultimately responsible for ensuring the proper management of employee EPF contributions. Holding them accountable for losses reinforces the importance of diligent financial management and compliance with EPF regulations. This accountability mechanism protects employee interests and encourages responsible behavior from employers.
The report extensively covers the process of exemption cancellation or surrender. What are the key considerations for an establishment contemplating such a move?
An establishment considering exemption cancellation or surrender must carefully consider the implications for its employees and its own financial standing. A thorough assessment of all liabilities, including outstanding contributions, interest, and damages, is crucial. A smooth transition requires meticulous planning and adherence to the prescribed procedures. Seeking professional advice is highly recommended.
This discussion has provided a comprehensive overview of the audit report. Thank you for your insightful contributions.